Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Monday as we get ready for another full week of June. Slowly working our way towards July the 4th, right around the corner. So, the holiday is coming up, so just be ready. A couple of things we'll talk about today, importantly, is the employment report on Friday was a lot stronger than expected on the headlines. And we'll kind of get into some of the internals this morning when we come back from the break. I've got some charts for you looking at some of the internal data for that employment report. It wasn't nearly as good as the headlines suggest, which has really kind of been the case for a lot of this economic data as of late. When we start talking about some of the economic data that has come out, we've seen some data that's like, well, it's okay, the economy's not terrible, but you kind of look underneath the surface and there's certainly some deterioration in that data. And now again, we're not to the point yet to where the data is going, hey, screaming recessionary outcome, right? But we are certainly slowing down economically. Now the importance of that, of course, is that will impact earnings, and we'll discuss that some more here in a few minutes. But what drives the market, what supports the market ultimately is earnings, and there's a very high correlation between increases or decreases in earnings expectations versus the market. So really, since April, earnings, Wall Street analysts have been getting a lot more optimistic, and they've been upgrading their earnings estimates. And so as they do that, it's not surprising that stocks go higher. So again, analysts are a little bit overly confident, shall we say, about earnings going into 2025, given the economic data that's come out as of late. Because while it is a function of buybacks and a lot of other things that are influencing the markets, there is the reality that earnings ultimately come from revenue, and revenue comes from economic activity. So if the economy is going down, those estimates are probably too high, and they're going to have to come down some. And that's potentially going to kind of limit the upside to the market if this data continues to weaken as we've seen as of late. So again, it's always a function of timing, and this is why it's always very difficult, to make a big decision about your portfolio. It's like, oh well, Lance said that we're about to head into a recession. I didn't say that. I'm just saying that the economic data is slowing down, and we need to be aware of that. And it doesn't mean that that's going to affect the markets any at all right now. At least in the short term, because markets are very ebullient. Positioning is very bullish right now. There's nothing on the short-term horizon that suggests there's any real risk to equities at the moment. Now that'll change, right? But not today. So this is, as we talked about before, be careful about making big macro changes to your portfolio based on a very long-term outlook. And look, and things can change. While the economic data is weakening now, doesn't mean it can't strengthen later if for some reason we start seeing a pickup in economic activity. Now that's hard to imagine right now, given the length of this advance that we're in, the reversal of monetary influence that we've had over the last few years. That's now coming back out of the system. So it's hard to see what the case would be that would strengthen economic activity from here. But it's certainly possible, right? Something could happen that we're not aware of, Government passes another huge spending bill of some sort to do infrastructure build out for AI, whatever it is. That could certainly influence economic activity. So again, be careful with big major macro moves in your portfolio, because things can change, and they often do change. Outside of that, over the weekend, it's really been pretty quiet as of late in the markets. There hasn't been, we've had economic reports, we've had Fed speakers out, but there's not been really anything market moving to any great degree. And again, this market's just been very quiet and has just been kind of running along this 20-day moving average. Now we're very much back to where we were, previously. So again, it's not been a really exciting overall market as of late. Kind of gets, we get these kind of boring, sleepy periods. And volatility has dropped, and again, we'll talk about that some more this morning. But again, as volatility gets compressed, there is a risk of a reversal in that compression, right? Complacency tends to lead to markets doing very unexpected things. And again, at this point, there doesn't seem to be anything, and we'll talk about this in a second, but right now, the markets are extremely complacent. So it's worth just making sure and keep a watch on your portfolio. Continue the process as we've talked about before. Rebalance risk, do those things in your portfolio on a regular basis, kind of prune and weed the garden, so to speak, and keep the portfolio in a good balance. Don't let things get too far out of whack. Okay, here's what you need to know before the bell this morning. Futures are pointing a little bit lower this morning, not surprising. Again, we've just had a very strong run in the markets over the last several weeks. We came down, tested the 20-day moving average, held onto that just as expected. We've now rallied back above that, set an all-time high last week. So again, probably over the next few days, potentially today, we're going to come down and retest that 20-day moving average again. And again, this is very much kind of like the market environment that we saw previously, all the way from November through really kind of February, March of this year, as just a very steady trend in the markets higher, just kind of bouncing off that 20-day moving average. That was the primary support for the markets. Every time the markets came down there, algorithms would kick in, start buying stocks. We seem to be kind of setting up right now that same type of environment that could run through July and into August. So again, we've got a couple of months here where this market could continue just to kind of migrate higher without some catalyst. And again, as we're coming into the next few weeks, we've got a FOMC meeting this week. We've got CPI inflation data out this week, something a lot more hawkish coming from the Fed, or a much hotter than expected CPI reading. We could see this market take a pretty sharp downturn, because this market is all predicated right now on the Fed cutting rates. And the expectations are that on Wednesday, the Fed will not cut rates, but that we're going to have an update onto the reversal of quantitative tightening beginning in July, and that rate cuts are still on the table, but probably maybe in the next couple of meetings, right? It'll be just later on this year. That's the expectation right now. Now, of course, the Fed could come out, say something, the recent employment report was much stronger than expected, and we're more concerned about inflation, whatever. They can say something a little bit more hawkish. And again, if they do that, I don't expect they will. I expect the message to be pretty much what the Fed speakers have been saying over the last several weeks, which is pretty much status quo, on track to cut rates. Everything's kind of working, to plan at this moment. That's just kind of been the message from every one of the Fed speakers, very much in consensus with each other. Not a lot of not a lot of dissent between Fed speakers as of late, and the market's been playing off of that. So this market's looking for easier monetary accommodation to come through Fed rate cuts, and of course through a reversal of quantitative tightening, reducing that drag of liquidity on the market. So markets have been rallying on that. So again, nothing much to change that here going into the election. I don't expect the Fed to do anything, too massive in terms of making any changes right now, particularly ahead of the election, because they don't want to be indicated that, they're influencing the outcome of the election for one party or the other, cutting rates, not cutting rates, hiking rates, etc. Pretty much expecting status quo from the Fed this week. Of course, we'll talk more about their actual results on Thursday with Michael Leibowitz. But again, this market just continues to kind of grind higher. So again, no reason to be overly concerned about the markets, but continue to do that risk management process. Trim your winners, sell your losers, rebalance to portfolio targets, etc. Just manage the risk in your portfolio. You'll be fine. All right, that's what you need to know before the bell this morning. When we come back, we'll talk a little bit about the employment report and some of the other data that suggests the economy is slowing down a whole lot more than maybe headlines suggest. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So let's talk a little bit about that employment report on Friday. 272,000 jobs. Certainly surprised the markets a bit on Friday with a much stronger than expected headline number. Of course, the internals, as we've talked about recently and over the last several reports in particular, have not been nearly as strong. The gap between the household survey and the BLS employment report, which is derived from the household survey. Now, these are not the household survey and the BLS report are not two separate surveys. The household survey is where they call 60,000 households first Tuesday of the month and say, hey, Brent, are you working? Brent says, Brent's standing there in his underwear with a pizza box. But yeah, I'm working. I work from home. Yeah, so he's employed, right? And so that's the household survey. That survey then gets a lot of magical adjustments to it. We add in the birth-death adjustment. We do some finagling with the ex-ARMA adjustments. That's all the mathematical adjustments for, seasonality, et cetera. And then we derive from that this BLS report. Well, the gap between the household report and the BLS is just getting larger and larger, which suggests that something's not quite right with the adjustments. And I've talked about before, if you just take the non-seasonally adjusted household survey and just apply 12-month average to the data, that does the job of smoothing seasonality, right? Because we do have periods where we have kind of weird fluctuations going with employment, right? We hire a bunch of people in November, December for temporary work to work retail for the holidays. Then they all get fired come January, or they quit and go, do something else. We have a lot of seasonal hiring during the summer for summer jobs, right? Because we have a pickup in activity. People are going on vacation, et cetera. So we have these weird seasonality things to it. And that's what the ex-ARMA adjustments are supposed to be fixing, is adjusting for this. But, it's very convoluted. The math doesn't seem to actually reflect reality to a lot of degree, a large majority of the time. A 12-month moving average does the same thing, right? And you smooth out all that data and you get a much better outcome. But hey, I'm not with the BLS. But again, that's once you start digging into that employment report on Friday, certainly suggests that the headline and reality are two fairly different things. And again, one thing that we've kind of been watching closely is the government assumes that if you work 2 part-time jobs, that you're fully employed, right? So if we take a look at what's happening between full-time employment, and there's a reason that full-time employment is so important. We'll talk about that in a second. But the gap between full-time employment and part-time employment is growing rather sharply. And this has been going on since really March of last year, that we've been hiring a whole lot more part-time work and actually cutting full-time jobs. Now, part of that is running in reverse over the last several weeks in California, where after California hiked their minimum wage to $20 an hour, they go, this is a win for the worker, the fast food workers. They now can get a livable wage at $20 an hour, and 10,000 people lost their jobs. So, not surprising, right? Because people aren't going to pay $25 for a Big Mac to offset the cost of $20 an hour minimum wage. So companies will do exactly what you think. They will reduce the most expensive labor. Now just think about this. You own a business. You have to have employees to own your business, right? So unless you're just self-employed all by yourself, right? So, but if you're running a business of some sort, manufacturing, construction, whatever it is, you've got to hire employees. Well, there's some employees you can't get rid of because they're essential to your business. Now, you never tell them that, right? Because they'll want more money. Like Brent, never tell him that, he's essential to the program, right? It's, because he'll ask for more money. So we just always let him know that, hey, anytime you want to leave, bud, just go ahead. We'll just get 10 more people like you, right? It won't be nearly as funny, but this is what happens with businesses, right? And so when sales slow down, and we've seen this a lot lately, right? Walmart, Target, Kohl's, etc. They're all reporting that sales are slowing down, right? They're seeing a slowdown in traffic in their business. We're seeing consumers become more picky about what they're buying. Fast food restaurants are seeing less visits. So when that occurs, the first thing that I have to start doing is go, look, I've got to cut back on my most expensive item in my business. What is that? Employment, right? Because I have employment, and then full-time employment in particular, because that provides higher wages generally, benefits, all those other things. So if I reduce a full-time worker and hire 2 part-time workers, it's actually cheaper. So this is what we've been seeing happening. Full-time employment is being reduced, part-time work is going up. So we're maybe keeping the same amount of workers, might even be increasing workers somewhat, but we're doing that through reducing full-time employment. And there's implications for that. And the reason that full-time employment is so important, of course, as I just said, if I'm growing a family, right? I want to have a house. I want to, have kids. Or I do have kids and a wife. I've got to support them. Well, full-time jobs generally pay more wages than part-time. Duh, right? They also provide benefits, 401k plans, health care, dental, vision, all that stuff, right? But that's all the cost. And this is what people, and this is one of the big fallacies about wages. We look at wages as a function of what we pay somebody. What we don't look at is total compensation. So yeah, I may pay somebody $60,000 a year to do a full-time job, but my actual cost is closer to 80 because of all the other benefits. And that's why U.S. labor is some of the most expensive in the world. And this is also why we offshore a lot of labor, simply because of that reason. But if you take a look at full-time employment, the annual rate of change in full-time employment, it's gone negative. Now, the only time that full-time employment goes negative is when you're heading into a recession. And the reason, of course, is obvious, is that I'm reducing the biggest consumers in the economy. because they're the ones that, if I'm running full-time employment, I'm probably building a family at some point. So I consume more than a part-time worker. And I spend more in the economy. So full-time employment is very important for economic growth. And this is one of the reasons that we talked about before, is that one of the reasons that economic growth has continued to slow since the turn of the century was because we're reducing full-time employment as a percentage of the population. And prior to each recession, we peaked in full-time employment relative to the population prior to the dot-com bust. We then recovered about half of that going into the financial crisis, and we've barely recovered much of that since the financial crisis. And then we knocked it off again during COVID, and we've now just gotten back to where we were in 2019. So we just had this declining trend of full-time employment relative to the population. And because full-time employment is what generates economic activity, it's why economic growth continues to drag at around 2%, 2.2%, which is a full percentage point lower than where we were going into the turn of the century. One of the other issues is also looking at the unemployment rate itself. So even though we had this stellar employment report of 272,000 people, the unemployment rate ticked up to 4%. Now, the reason that's important is because we've been trending above the 12-month average of unemployment really since the beginning of the year. And historically, when the unemployment rate is above the 12-month average of the unemployment rate, it's typically occurring heading into and during a recession. Now, I'm not saying we're in a recession right now, okay, because we don't know that. And again, when you look at that, and this is the problem with these charts, is that when you look at a chart, bring that chart back up real quick. So when you look at a chart like this, you go, well, see, it's clear. When the unemployment rate is above the 12-month average, it's a recession. So we're in a recession right now. Well, no, we don't know that, because going back in history, those gray bars that are the recession, we didn't know that for 6 to 9 months until after the fact, right? So yes, we may be in a recession right now, but we're not going to know it for another 6 or 9 months. So it's important to always keep that in the back of your mind. It's be careful with assuming that we're in a recession at the moment because of whatever reason it is. There's a lot of data that has to stack up behind that. And the National Bureau of Economic Research is going to wait for all the revisions. Now, the one thing about the employment report on Friday, that gap between the NSA, the non-seasonally adjusted household survey, and the BLS report, that suggests we're going to see negative revisions to the employment report going forward, the official one. But we're not going to know that for 12 months when they come back and do the annual revisions. And we'll find out theoretically next year that, it wasn't 272,000 jobs that were created in May. It was 50,000 or whatever. And we'll see this big negative revision, and then that NSA gap will close up. All right, quick break. We'll come back. We'll talk a little bit about, the economy, its impact on the markets, and, kind of where we go to from here. Don't go away. More of the Real Investment Show coming right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA do you go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Danny, you know inflation's getting bad. You remember back in the day when strippers used to have names like Crystal and Diamond after something really expensive?
No.
The Real Investment Show podcast.
Well, now you go to the men's club, it's like, welcome to the stage, gas and eggs. So, I mean, you just know stuff's getting bad, man. Inflation.
Same show, your schedule.
Where'd you get this from, Lance? Is this?
I was thinking about this last night. I was like,
at realinvestmentadvice.com.
Because it's on all cash business.
Yeah.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, a couple other things here. Two things I want to get into this morning. We'll talk a little bit about commodities as well this morning. But one of the things that, this is important about, and as I was explaining earlier, is that if you take a look at earnings for the S&P 500, analysts have just gotten really excited about the markets. And currently, right now, we're at about $191 a share in terms of earnings as of Q1. So, we're still working through Q2 right now. Most everything's reported. We'll have the final numbers here very shortly. But as of Q1, we're at $191 a share. So going into the end of next year, so 18 months from now, estimates are closer to $252 a share. So that is a massive annual increase in earnings per share estimate. So Wall Street's gotten really far out there. It's like, oh, this is, we're in boom times for the economy, yet the data doesn't really support that. But that's what Wall Street analysts expect, is just a very sharp increase, this 45-degree line of growth. So, and growing on a year-over-year basis at 20% going into next year. It's pretty phenomenal, right? And so that is what supports current valuations. I'm doing an article now on valuations for next week. But not surprisingly, economists, Wall Street, economists have gotten very confident in the economy. That's why they're hiking their earnings estimates. Their expectations of a recession are very low. The Atlanta Fed just last week. Now, this when I wrote this article, the employment report hadn't come out. So right now, we did see the estimate for Q2 GDP tick up to a little like 2.1%, but it was 1.8% before the employment report. But that's down from 4.1. So there's been a very sharp decline in economic activity just over the last month. And we've seen this in numerous parts of various data reports that we've talked about here on the show. So, but here's the important thing is that the economy is slowing down. As the economy slows, as all that money that we shoved in there from the stimulus, everything else is slowing down, that's starting to weigh on economic activity. And again, there's a very clear declination of economic growth since quarter 3 of last year. That's expected to continue to decline. Now, it'll start to flatten out here a little bit, but there's been a very sharp decline in economic activity. Not surprising. Again, all that money we sent in, all those stimulus checks, all that's starting to reverse. And so we're now starting to kind of see this. Now, importantly, as we've talked about before, the economy is 80% services and 20% manufacturing. So very important to understand that because this is why we're not the 70s anymore. Back in the 70s, it was reversed, 80% manufacturing, 20% services. But importantly, services right now are still holding ground. So that's what's keeping economic activity going at the moment. That's why we're not technically in a recession. Yes, manufacturing data has been in a recession, absolutely, but it's only 20% of the economy. 80% of the index is services, which has declined a lot. It's slowed down a lot, which is why economic activity is slowing down, but it's not contractionary yet. And historically, whenever we've had manufacturing in contraction going back to 2000, but services weren't, we didn't have a recession. Now, we had an economic slowdown, clear slowdown in economic activity, but it wasn't recessionary. When services goes negative along with manufacturing, that's when you're in a recession. And that's why we haven't had a recession so far in the cycle, despite a very long period of, manufacturing data being negative, services weren't. And so that's been one of the confounding issues for a lot of people. Like, well, the data is very clear. We're in a recession. No, we're not, because services aren't. Now, what's important, though, is that pay attention to that services number. So if we take a look at an economically weighted composite index of ISM, manufacturing and services. So now the red line is 80% services, 20% manufacturing, taking the data, right, from manufacturing and services, building a composite that's economically weighted. The one thing that jumps out, though, is that this market is well ahead of what's happening with the economic data. Normally, there's a fairly close correlation. Big deviations like this shouldn't exist. In other words, the market right now is just, way ahead of the underlying economic support. Now, again, that doesn't mean the markets are going to have a major crash, but it certainly means that we may see a more challenging period of upside returns, particularly if the expectation for earnings begins to disappoint reality. And again, if you take a look at the deviation of earnings, so if you take a look at a long-term growth trend of earnings, they grow at about 6% on average, peak to peak. Lay an exponential growth trend over the long-term data stream going back to 1947, and what you find out is that we have a deviation that is of a magnitude larger than we've seen, only at the pandemic boom peak and only back in the financial crisis, even larger than the tech bubble. So again, those deviations from the exponential growth trend can't last forever, right? So again, if we start seeing negative earnings revisions, which you would expect, given the deviation from economic reality, that's where the potential problem comes in for the markets. And again, that doesn't mean the markets are going to crash, but it could mean that upside is going to become a lot more challenging for the markets later on this year or next year, because those estimates are going to have to come down to some degree. So just something to kind of pay attention to. Because when you look at that employment report on Friday, start digging into those internals, the economic data really has not been all that supportive. And services, while they're in expansion territory right now, is very volatile. That thing jumps all over the place, and particularly as of late, that number's been all over the place. Now, you got to remember these surveys, ISM Manufacturing and Services, those are surveys. That's not actual data. That's me calling up a business and go, how many sales did you have this month? We sold one item this month. Okay, terrible. Normally they sell 10, right? We sold one. Well, how is that? Well, that's great because we sold none last month, right? So that's a big input into that. So all of a sudden sales, big jump because you sold none last month. You sold one this month. That's a 100% increase. Even though you sell 10, you're down 90%, but that doesn't get factored in. It's just what happened this month versus last month. That's services, manufacturing, et cetera. So again, these are surveys, more about how you feel, not about the actual data. But again, they do have a big bearing on economic trends. And they do have a very high correlation to sales growth, earnings growth for companies, et cetera. There is a correlation. And again, those numbers are running right along that line that separates contraction from expansion. So just something to pay attention to. I want to talk a little bit about commodities as well. Let's switch gears because, lately there's been a lot of headlines discussing commodities because, orange juice has been, going crazy. Cocoa was going crazy. And that's not uncommon. We've seen this throughout history when you talk about commodities. And, what's important about commodities is always that they are very, very volatile because there's a whole psychological component to commodities that have nothing to do with the actual commodity itself. But, one of the problems that investors get themselves into on a regular basis is, starting to chase commodity type assets, right? Hard commodities and soft commodities both. And they think over and over again, well, this time is different for this reason or that reason, and it never is, and they wind up losing a huge amount of money in commodities because of the volatility of the commodities themselves. And again, if you take a look at the asset quilt of returns, commodities are some of the most volatile assets. They may be at the top of returns one year and their bottom of returns next year. And that's a regular basis on commodities going back through history because of what drives the prices of commodities. It isn't the supply-demand balance of commodities. And this is generally the fundamental nature. It's like, oh, there's a crop shortage. And so, orange juice prices go shooting through the roof because there's a crop, there's, some blight on the orange crop or whatever. And things go shooting through, the price goes shooting through the roof initially because there's going to be a supply-demand break. But then another series of events happens that causes the problem ultimately. And this happens repeatedly throughout history with commodities that causes something else to happen. And, if you take a look at a chart of the total return of commodities over the last 50 years, if you had invested $100 in commodities 50 years ago, you would be up 40% on your money right now on a total return basis. And the reason is because you have these massive booms where you make a lot of money and then you lose it all because of the reversal in the commodity prices. Now, when we come back from the break, I'll explain to you why that boom bust cycle happens over and over and over again. And it's not probably what you think is causing it. Talk about that next.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will NVIDIA go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So the boom and bust in commodities, as we were talking about, is always fascinating to me because it's a cycle that just repeats itself over and over again. It doesn't matter whether it's a hard commodity like copper or a soft commodity like orange juice or cocoa or whatever it is. And you have these big booms and busts that occur just over and over again. And the reason is because in my article, I use orange juice as an example. We can talk about copper because copper's been in the news lately as well. And there was an event that just happened around copper here in Houston, which kind of goes to the same point. And we've seen this before. Brent will tell you that back probably around 2007, we were going through a copper boom, and I'll tell you the story behind that one as well. What happened to the radio transmitter for the radio station? But so it starts out with something happens, right? And there's a supply-demand imbalance. So there's simply just not enough supply of copper for whatever needed is. So lately there's the conversation that, there's, a need for all this copper for AI, electric vehicles, et cetera. So there's this supply-demand imbalance. So companies aren't able to produce enough copper in order to meet the demand for copper, right? So prices go up. Exactly what Economics 101 says, and that's fine and dandy. Okay. Well, as the price increases, then Wall Street gets involved. And on the NYMEX, this is where, whether it's oil prices, whether it's, copper prices, it doesn't matter. It's all commodities. If they are a commodity of any type, falls in the same category. Because once Wall Street gets involved, the speculators take out leveraged contracts called futures contracts on these commodities. And so they start bidding up the price of oil or copper or whatever it is. And the more the prices rise, the more contracts they take out, driving the price higher. And then, of course, all the narratives come out. Well, this time is different because of the AI chase. Then there's, not going to be ever enough copper ever again. And so companies are going to have to produce all this copper. Well, first of all, companies can only produce so much copper at a time. But if prices go up, what are they going to do? They're going to increase their copper production. So Next step is that that producers of those commodities, whether it's a gold miner or a copper miner or an orange juice maker or whatever it is, they're going to, man, at this price, for per pound of copper, I'm going to ramp on production. So they go start up another mine. They go hire more workers. They buy tractors. This is all kinds of stuff. So they start producing a lot more copper. And so the price is going up. That's fine. Now there's copper hitting the market. So now we've got more copper coming in or more orange juice or whatever it is. And there's another byproduct of this. And I was just telling you, back in 2007, we had a copper run. And there's copper everywhere. There's copper in houses. There's copper in, refrigeration units. There's coppers in air conditioners, copper in electric lines. There's copper everywhere in the economy. And so people started doing what? When the price of copper gets high enough, people start stealing air conditioners, and they actually raided our transmitter, the radio transmitter, stole all the copper out of the radio transmitter, couldn't broadcast, right? So until we get the lines replaced. And so now all of a sudden, the copper hits the market. There's a famous story about the Hunt brothers that goes right along with this. Back in the early 90s, the early 80s, the Hunt brothers tried to corner the silver market. And so they started buying all the contracts for delivery on silver. Well, prices of silver soared. What does everybody have at home? Silver jewelry, grandma's silverware, silver tea sets that belong to great grandma. I don't know if we even make silver tea sets anymore, but they're out there. So all these people started showing up. They were scraping now this for you young people, you won't know this, but back in the day we had Polaroid film. And you had a camera you'd take a picture of and it'd spit out the picture, and then you would peel it off and it would magically materialize. The image would materialize on this Polaroid film. The back of that film was silver. And so people were scraping the back off of Polaroid film and taking it in to silver dealers to sell silver because of the price. Well, the problem was the Hunt brothers are trying to buy all the contracts for delivery. They thought they were going to corner the silver market, but more silver kept showing up. Finally, it busted the Hunt brothers. They couldn't keep up with it, and so the price of silver crashed. But this happens over and over again. So there's a supply increase that goes along with that. So, or what happens is, in the case of orange juice, is orange juice is too damn expensive, so we start drinking lemonade, right? And then what happens, of course, is that as the price begins to fall because of the supply increase, speculators start to short. They sell their contracts, and they start shorting the price of the commodity, which causes the bust. So as they cause that decline in prices, producers start doing what? Well, last year I was, planting a bunch of oranges, and I quit planting my lemons because everybody wanted orange juice. And now nobody wants the orange juice, so I'm going to go plant lemons. And so what you wind up with is a reversal. As prices fall, you get a reversal in the price, producers pull back on production. So that's why in commodities, and that's why, if you're trading commodities, it's fine. There's nothing wrong with trading commodities, but you don't hold commodities. You trade commodities. You buy it for the price. When the price first starts to run and there's a supply-demand imbalance for whatever it is, you trade the trade, but don't forget to take profits. Because that's why commodities regularly boom and bust, because prices are not driven by the economy alone. This is the mistake that investors make repeatedly over time, is they go, well, there's this fundamental reason for A, B, or C, right? There was this plight, whatever it was, and for oranges, or there was just a shortage of copper, for whatever reason it was. There is a supply-demand fundamental reason that starts the cycle, but prices are driven by the NYMEX, up and down. And same thing goes for oil. That's why oil, remember back in 2020, 2021, oil prices went negative, right? Oil prices didn't really go negative. That was all the futures contracts. But we had this huge run in oil. The thesis was that oil was going to go to $300. Goldman Sachs, oil's going to $300 because of the war in Ukraine. and then they went negative. But that's what happens on Wall Street. Wall Street drives the prices. The event, the supply-demand imbalance, that's just the initial marker. After that, it's all NYMEX. It's all Wall Street. So make sure that if you're trading these commodities, it's fine. Just don't hold them. Trade them for what they are. Trade for that. But realize that at some point, you're going to, the producers are going to start producing a whole lot more. You're going to wind up with a glut, and then things reverse. And that's why you see these big boom-bust cycles in commodities all throughout history. Just be careful with that. So, all right. That article, by the way, is on the website, realinvestmentadvice.com. So if you want to go, it was Friday's article talking about commodities. So there's a bunch of charts in there, explanation, et cetera, about commodities and what goes on. So just kind of wrapping up the show here for the day. A couple of things is that buybacks have been going strong here for a while. So they start to go into blackout on June the 14th. So one of the supports for the market is going to start being reduced. Now, that doesn't happen all at once. It's not like on the 13th, everybody's buying stock. On the 14th, everybody quits. That's not the way it works. It's just 2 weeks ahead of the earnings announcement. Then, 30 days before the earnings announcements, they start entering blackout. So it tiers, it staggers. So as we start getting close to Apple, as an example, announcing earnings, they'll stop buying back shares. They'll enter their blackout period. But NVIDIA, as an example, they report very late. So their window doesn't close for another 30 days. So there's this stagger increase of blackouts that occur on buybacks. But the important thing is that starting the 14th, that blackout window opens or closes, or the buyback window closes on the 14th. And it will ramp up over the next 3 weeks. So, on the 14th, the market's not going to fall apart. But the important thing is as we move into July, one of the primary supports for the markets will start to reverse. Now, we talked about this back in February, March, and of course, April, we had a 5% correction. Now, I'm not saying that's going to happen. That's not going to happen again, theoretically, could. But it is an important point that one of the primary buyers of stock, in fact, the net buyer of equities over the last 20 years, has been corporations. So you are removing, over the course of the next month or two, a primary buyer from the market, which could certainly impair the ability of the markets to move higher. Doesn't mean that it has to, right? Markets can go up even though corporations aren't buying back stock. But you're going to need another event. The Fed cut rates, et cetera, could certainly do that. But just something to be aware of. Okay. That wraps up the show for today. We'll come back tomorrow, pick up. John Penn should be here with me. We'll see. Want to talk a little bit about, kind of an economic change happening in the markets as Gen Z now is starting to take on the work of trades rather than going to college. And what does that mean? Talk about that tomorrow in the next edition of the Real Investment Show. Have a great day. We'll see you back here tomorrow. Have a great day.